Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast. Hello, everyone. Today is January 27th, 2025. Welcome to the first month of the trading year, and it has been exciting. We've got Trump inaugurated and the rest of it. A bunch of artificial intelligence information coming out, a lot of earnings coming out, and we're tracking all of it. So first, I want to start off by saying thank you for listening to the Northbound Wealth Podcast. Really appreciate your support, your likes, your subscribes. And hopefully this show is informational, educational, and interesting. All right, so here we go. Let's dive in to reviewing last week and talking about what's going on in markets. So stocks rallied last week as investors reacted positively to a handful of better than expected corporate earnings reports and developments out of Washington, D.C., like the optimism that the Trump administration will reduce taxes and regulations. The Standard & Poor S&P 500 index gained 1.74%, closing at 6,101. It reached a record intraday high of 6,128 on Friday, but ended the session slightly below the record closing level of 6,118 posted on Thursday. The S&P 500 is now up 3.7% for the month and 25% to the positive from a year ago. The NASDAQ Composite Index added 1.65%, closing at 19,954 after reaching fresh highs during the week. The Dow Jones Industrial Average rose 2.15%, closing at 44,424. The MSCI EAFE Index, which tracks developed overseas stock markets, added 3.03%. So there's a flurry of news. The week only had 4 trading sessions as the U.S. stock market was closed on Monday for Martin Luther King Jr. Day. Monday was also the inauguration day, making the start of President Donald Trump's second term. Investors are hopeful the newly inaugurated president will follow through on his plans to cut taxes and regulations. Markets surged over the first 3 trading days as investors cheered a flurry of new policy announcements and executive orders following Monday's inauguration. For example, investors responded to news that the White House trade team is considering taking a softer stance on tariffs. So the bark is louder and more meaningful than the bite actually will be. So it was also a good week for Q4 company reports and other upbeat corporate news. Markets leveled off on Friday as investors were disappointed that existing home sales fell to a 30-year low. Well, no kidding. Interest rates are too high. Come on. And it's seasonality. Sentiment was also boosted by stronger than expected quarterly earnings from companies including GE Aerospace, Union Pacific, and Netflix. By sector, communication services had the largest percent gain of the week, up 4%, followed by a 2.9% increase in healthcare and 2.4% rise in industrials. So you're seeing kind of a value trade or a cyclical trade pickup as the tech kind of sell-off was happening, actually starting again this week. So Netflix was a top performer in communication services with its shares climbing 14% on the week as the streaming entertainment company reported Q4 earnings and revenue above expectations as it added 18.9 million subscribers worldwide, almost double the market estimates. Netflix also issued above consensus Q1 guidance. Telling you, traditional media is dying. It's dying. I heard that the Washington Post has like 3 million subscribers when it just had 20 million subscribers like a year ago. So that's just one indication, and it's like that across the board. So in health care or life sciences, shares of Moderna jumped 22% after the vaccine maker was awarded $590 million by the U.S. Department of Health and Human Services for the development of mRNA-based influenza vaccines. Moderna also said it had been awarded a tender to supply its COVID-19 vaccine in the European Union, Norway, and North Macedonia. I just want to note that that was done in the prior administration. That wasn't done in the new administration, which is crazy. $590 million. Jeez. GE Aerospace shares led the industrial sector's gainers, rising 7.6% as the company reported Q4 adjusted earnings per share and revenue above analysts' mean estimates. The high end of the company's guidance range for 2025 adjusted EPS also surpassed analysts' mean estimates. Energy was the lone decliner for the week, shedding 2.9% amid a drop in crude oil futures. Shares of Halliburton fell 7% as the company's Q4 adjusted earnings per share came in a penny above analyst consensus estimates, but its revenue slightly missed the street's view. Next week's earnings calendar features AT&T, Boeing, Starbucks, Microsoft, Meta, Tesla, IBM, Apple, Visa, MasterCard, Caterpillar, UPS, Exxon, AbbVie, and Chevron. Economic data will include December new and pending home sales, Q1 gross domestic product, and the December personal consumption expenditures price index, among other reports. Also, the FOMC, or the Federal Open Market Committee, will hold its first meeting of 2025. So, thank you, Y-Charts, for a lot of information here. Weekly market insights, major index return summary. Dow Jones Industrial Average year to date is up 4.82%. Or excuse me. Yeah. Year to date, it's up 4.82%. MSCI EFA is up 3.48%. NASDAQ's up 3.86%. And the S&P 500, as it closed last week, is up 4.10%. Starting the week, given that it's today and it's Monday, we're giving some of that back. There is a China DeepSeek AI startup that is claiming that they are doing a better job at a lower cost in the area of AI, open AI, and large language model processing. And so it's kind of shocking markets across the board, but I think it's overblown and just a knee-jerk overreaction to information from China, which to me is crazy, because why are we putting so much credence on what China says? In their own competitive perspective, they think they're better. So it's interesting. 10-year treasury rate is at 4.63%. So that's up from a month ago. A month ago, we were at 4.59. 3 months ago, we were at 4.21. And a year ago, this time we were at 4.18. So we're up near the top end of the 4 handle range. And hopefully we don't get any higher than that. But we'll see how it goes. So let's look forward. The stock market is a discounting mechanism. Okay, that's a reminder, meaning today's stock prices reflect all available information, including present and potential future events. And for the most part, the markets reacted positively to the news coming out of Washington last week. Some news spurred broad-based market moves, while other news had a more sector-specific impact. For example, on Thursday of last week, markets reacted positively to the news that the White House believes interest rates were too high and want to see rates trend lower. The Fed's first scheduled 2-day policy meeting ends on Wednesday, so investors may be looking to see if Fed Chair Jerome Powell addresses the new administration's concerns. I already went over key economic indicators. We got a lot of data coming out this week, and also I did go over the majority of the notable companies reporting earnings. So, tax tip of the week is electronic filing options for military families. So, the Internal Revenue Service, or IRS, offers several online resources for military members and their families. Some of these resources include IRS Free File. This program offers online tax prep, electronic filing, and direct deposits of refunds. There is at no charge. Members of the military and their families with incomes below $72,000 a year can choose from any of the Free File tax software companies the IRS has compiled. Free File fillable forms are available for those with incomes above $72,000. Free File can help taxpayers determine their earned income tax credit, child and dependent care credits, and recovery rebate credit. Militax is another free tax resource available for the military community, offered through the Department of Defense. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, stay tuned for the next segment. It's got a lot for you here. I wanted to share an article from John Butters over at FactSet. He's the Vice President, Senior Earnings Analyst. And he does this weekly research report called Earning Insights provides analysis and commentary on trends in corporate earnings data for the S&P 500, including revisions to estimates, year-over-year growth, performance relative to expectations, and valuations. And he is widely used source for the media and has appeared on CNBC, Fox Business, Business News Network. In addition, he's been cited by a lot of print and online publications, including the Wall Street Journal, Financial Times, New York Times, MarketWatch, and Yahoo. And he's spent over 15 years of experience in the financial services industry. So I just want to give a shout out to John. Good job on these reports. I do read them from time to time, not all the time, but from time to time, and it's worth sharing. So I just want to give a shout out there. So he says on January 24th in his earnings season update, at this early stage, the fourth quarter earnings season for the S&P 500 is off to a strong start. Both the percentage of the S&P 500 companies reporting positive earnings surprises and the magnitude of earnings surprises are above their 10-year averages. As a result, the index is reporting higher earnings for the fourth quarter today relative to the end of last week and relative to the end of the quarter. In addition, the index is reporting its highest year-over-year earnings growth for Q4 in 2024 in 3 years. Overall, 16% of companies in the S&P 500 have reported actual results for Q4 2024 to date. Of these companies, 80% have reported actual EPS above estimates, which is above the 5-year average of 77% and above the 10-year average of 75%. In aggregate, companies are reporting earnings that are 7.3% above estimates, which is below the 5-year average of 8.5%, but above the 10-year average of 6.7%. Historical averages reflect actual results from all 500 companies, not just actual results from the percentage of companies that have reported through this point in time. So during the past week, positive EPS surprises reported by companies in the financial sector were the largest contributors to the increase in the overall earnings growth rate up for the index over this period. Since December 31st, positive EPS surprises reported by companies in the financial sector, particularly offset by downward revisions to EPS estimates for companies in the energy sector, have been the largest contributors to the increase in the overall earnings growth rate for the index over this period. As a result, the index is reporting higher earnings for the fourth quarter today relative to the end of last week and relative to the end of the quarter. The blended combines actual results for the companies that have reported and estimated results for companies that have not yet to report. Earnings growth rate for the fourth quarter is 12.7% today compared to an earnings growth rate of 12.4% last week and an earnings growth rate of 11.8% at the end of the fourth quarter, December 31st. So if 12.7% is the actual growth rate for the quarter, it'll mark the highest year-over-year earnings growth reported by the index since Q4 of 2021. It will also mark the 6th consecutive quarter of year-over-year earnings growth for the index. 7 of the 11 sectors are reporting year-over-year earnings growth for Q4. 6 of the 7 sectors are reporting double-digit growth. Financials, communication services, information technology, consumer discretionary, healthcare, and utilities. On the other hand, 4 sectors are reporting a year-over-year decline in earnings for the quarter. Only one of these 4 sectors is reporting a double-digit decline, and that would be energy. In terms of revenues, 62% of S&P 500 companies have reported actual revenues above estimates, which is below the 5-year average of 69% and below the 10-year average of 64%. In aggregate, companies are reporting revenues that are 0.7% above estimates, which is below the 5-year average of 2.1% and below the 10-year average of 1.4%. Again, historical averages reflect actual results from all 500 companies, not the actual results from the percentage of companies that have reported through this point of time. During the past week, a negative revenue surprise reported by a company in the utility sector was the largest contributor to the slight decrease in the overall revenue growth for the index over this period. Since December 31st, positive revenue surprises reported by companies in the financial sector have been offset by negative revenue surprises reported by companies in other sectors, led by the utility sector, resulting in no change to the overall revenue growth rate for the index over this period. As a result, the blended revenue growth rate for the fourth quarter is 4.6% today, compared to a revenue growth rate of 4.7% last week and a revenue growth rate of 4.6% at the end of the fourth quarter, ending December 31st. If 4.6% is the actual revenue growth rate for the quarter, it will mark the 17th consecutive quarter of revenue growth for the index. 8 sectors are reporting year-over-year growth in revenue for Q4, led by information technology sector. On the other hand, 3 sectors are reporting a year-over-year decline in revenue for Q4, led by the energy sector. Looking ahead, analysts expect year-over-year earnings growth rates of 11.3% and 11.6% for Q1 2025 and Q2 2025, respectively. For current year 2025, analysts are predicting year-over-year earnings growth of 14.8%. That's pretty good, guys. If you really think about it, that is pretty good for the year. The forward 12-month P/E ratio is 22.2, which is above the 5-year average of 19.7 and above the 10-year average of 18.2. This P/E ratio is also above the forward P/E ratio of 21.5, recorded at the end of the fourth quarter ending December 31st. During the upcoming week, 102 S&P 500 companies, including 9 Dow 30 components, are scheduled to report results for the fourth quarter. So, things are looking good in earnings land, and that is continuing this week on Monday, January 27th, just a couple days after that report was issued. And I read the FactSet report as well as JP Morgan and many other reports. Y charts I tap into as well, and I follow this on my alerts and on an app called Quarter. Really love that one, where I listen to conference calls and read financial reports and check out what's going on across all the stocks that my company pretty much owns. So awfully busy tracking all this stuff. But John Butters, thank you again. FactSet, check it out. Go to their website, factset.com, I believe what it is, and subscribe to that report he sends out during the course of earnings as companies are reporting. Stay tuned for the next segment. Hello, everyone. I put an article out there on my blog at www.northboundwealth.com/blog, and it is regarding the 10 facts you may not know about Social Security. So, Social Security is often misunderstood or underestimated in a retirement strategy. However, as financial professionals, we've seen how it can play a crucial role in our clients' overall financial strategy, regardless of their income level or net worth. This program extends beyond basic retirement benefits, offering vital programs and strategic opportunities that can influence your financial future. From unexpected benefits to strategic claiming decisions, understanding the nuances of Social Security can lead to more informed financial choices. The following 10 surprising facts about Social Security reveal critical insights that may be able to enhance your retirement strategy. The lesser known aspects demonstrate why Social Security deserves careful consideration in many comprehensive financial plans and strategies, no matter your current financial status. So let's get started. Number 1, Social Security is more than just retirement benefits. So many people primarily view Social Security as a retirement program, but it also offers critical financial support in the event of death or disability. According to the Social Security Administration, or SSA, approximately 96% of people aged 20 to 49 who worked in jobs covered by Social Security in 2023 had access to these protections. For a younger worker with the average earnings, a spouse, and 2 children, that's equivalent to a life insurance policy with a face value of nearly $948,000 in 2023. What's more, about 90% of people aged 21 to 64 who worked in covered employment in 2023 were insured through Social Security in case of severe disability. While it is not something we like to think about, 8% of recent entrants to the labor force will die before reaching full retirement age, and many more will become disabled, making Social Security a vital safety net. So 1/5 of Social Security benefits receive disability or young survivors benefits. So disabled workers and dependents are 13%, young survivors 3%, retired workers dependents and aged widows receiving retirement or survivor benefits is 84% of that pie. That's as of May 31st, 2024. The source of that is the cbpp.org. Number two, delayed claiming can increase benefits. So, as stated by Social Security Administration, for each year you delay claiming Social Security past your full retirement age or FRA, your benefits increase by 8% until the age of 70. This strategy can potentially benefit individuals who can afford to delay claiming their benefits. While waiting to take your benefits may sound like an easy answer, deciding when to begin taking Social Security is one of our most common questions. It may seem straightforward, but it's more complex than it looks. Since everyone's circumstances are unique, there are a few considerations that you may want to take into account. One being, will you continue working? Social Security may withhold some of your payment if you work while collecting early benefits. Number two, are you married and does your spouse anticipate benefits? Number three, how is your health? Of course, your health status could affect your decision on when to start taking benefits. Your answers to these questions can significantly impact your Social Security strategy. Number three, Social Security benefits are adjusted for inflation. Unlike some private pensions, SS benefits can be adjusted annually for inflation. It's called the cost of living adjustment or COLA. It is designed to help maintain the purchasing power of your benefits over time, potentially managing the impact of inflation in retirement. According to the Social Security Administration, the COLA for 2025 is 2.5%. This follows an 8.7% COLA for 2023, obviously because we had high inflation, and that erodes purchasing power. One of the most significant increases in recent history due to, again, high inflation. Note that there is not always a COLA increase every year. As the chart on my blog shows, there were 3 times in the past 20 years when beneficiaries received no COLA due to lack of inflation. Number 4, benefits may be subject to taxation. So many retirees are surprised that their SS benefits may be subject to federal income tax. This taxation can affect your overall retirement income strategy. Here's what you need to know. Taxation threshold. So taxation begins when your combined income exceeds certain thresholds, like $25,000 for individuals, $32,000 for married couples filing their taxes jointly. Your combined income is the sum of your adjusted gross income, non-taxable income, half of your Social Security benefits. If your combined income exceeds $34,000 as an individual or $44,000 married filing jointly, up to 85% of your benefits may be taxable. Don't ask me why, but that's the way it is. It's the laws of the land at the moment. Managing tax payments. If you owe taxes on your Social Security benefits, you have 2 choices. Number 1, pay the IRS directly when you file your annual tax return. And number 2, have taxes withheld from your monthly Social Security payments. So you can choose to have 7%, 10%, 12%, or 22% of your monthly payment withheld for taxes. State taxation. So while most states don't tax SS benefits, the states that still do, according to an August 2024 report in Kiplinger.com, include Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Each state has its own rules and exemptions. So here's some strategic considerations. The taxation of Social Security benefits can affect your overall retirement income strategy. Consider how other sources of retirement income might push you into a higher taxation bracket for your Social Security benefits. Roth IRA distributions are not included in the combined income allocation, potentially making them a valuable tool in managing your tax liability. To qualify for the tax-free and penalty-free withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and occur after age 59 and a half. Tax-free and penalty-free withdrawals can also be taken under consideration in other certain circumstances, such as the owner's death. The original Roth IRA owner is not required to take minimum annual withdrawals or required minimum distributions By working with financial and tax professionals, you may be able to develop a strategy that's designed to manage your tax burden while maximizing your retirement income. All right, number 5, spousal benefits can enhance retirement income. So, your non working spouse may be eligible to collect Social Security benefits based on your work record. To qualify for spousal benefits, you must be collecting Social Security, retirement, or disability benefits, and your non working spouse must be at least 62 years old. Any age, if you have a child who is younger than 16 in your care or has a disability and is entitled to benefits on your spouse's record. Be married to you for at least 1 year. So, be married to you for at least 1 year. That's another requirement. The maximum spousal benefit is 50% of your full retirement age benefit amount. Social Security will permanently reduce benefits if your spouse claims before their full retirement age. If you delay claiming past full retirement age, the spousal benefit does not increase beyond 50%. So keep that in mind. In the event of your death, your spouse may be eligible for survivor benefits based on your Social Security record, but will not receive your benefits in addition to their own. They'll only receive whichever benefit is higher. If your surviving spouse or a surviving divorced spouse remarries before they reach the age of 60, they cannot receive benefits as a surviving spouse while married. If your surviving spouse or a surviving divorced spouse remarries after they reach the age of 60, they will continue to qualify for benefits on your Social Security record. Very interesting. There's some really crazy stories about why they changed the rules on that. Number 6, Social Security may act as a buffer against market volatility. Well, that's obvious. It's periodic equal payments over a period of time, over your lifetime, usually. Because it provides stable income, Social Security offers a steady income stream that is not dependent on market performance. This monthly payment can help cover basic living expenses without tapping into investment accounts during market downturns. And that is absolutely true. Number 7, your total benefit might surprise you. You might be surprised by the aggregate Social Security benefit you may be entitled to. The expected value of lifetime Social Security benefits for a single male with a maximum taxable earnings, which is 23, is $160,200, who turns 65 in 2025 is $39,800 annually and $634,000 over an average lifespan. For a married one earner couple with maximum tax table earnings, the benefit would be $59,600 annually starting in 2025 and about $1,076,000 total based on life expectancy. All right, number 8, higher income can mean higher Medicare premiums. So you may not be aware that high income beneficiaries may pay higher premiums for Medicare Part B and D. In 2024, individuals with modified adjusted gross income above $103,000 or $206,000 for married couples will pay higher premiums. The chart on my blog shows details the increased monthly costs for Medicare Part B based on income levels. So go out to www.northboundwealth.com/blog and look that chart up. It's all there. Number 9, Social Security offers international benefits. So not everybody knows this. If you're considering retiring abroad, it's essential to know that Social Security benefits can generally be received while living in most foreign countries. This income can provide flexibility in retirement living arrangements. Once you begin receiving Social Security benefits abroad, the Social Security Administration will send you a questionnaire every 1 to 2 years. This questionnaire will determine if you're still eligible for benefits. So you got to make sure you fill that out. If you do not respond, your benefit payments may be stopped. While the Social Security payments can often continue if you are living abroad, Medicare won't pay for health care or supplies you get outside the US. Some exceptions would allow you to get coverage outside the US under Medicare Part A hospital insurance and Part B medical insurance. So if you plan to be an expat upon retirement, please speak to a professional about your plans and do your own research. Number 10, The windfall elimination provision may affect benefits. According to the SSA, or Social Security Administration, individuals who have worked in jobs not covered by the Social Security, which is some government positions, and are eligible for a pension from that work may see their Social Security benefits reduced due to windfall elimination provision. Understanding this provision, if it applies to you, is crucial in accurately determining how much Social Security benefits you can expect. All right. And finally, don't underestimate the importance of Social Security. While SS income may not be the primary source of retirement income for individuals, it can play a significant role in a comprehensive retirement strategy. Understanding these lesser known aspects of Social Security can help you make more informed decisions about your retirement and potentially enhance your overall financial picture. As financial professionals, determining your sources of retirement income and how your different sources can work best together as an integral part of your services and your income and your overall picture. If you have any questions about any of this stuff or retirement income, including Social Security, please don't hesitate to reach out to our office at Northbound Wealth Management. We'd be happy to help. 317-399-1107. All right, stay tuned for the next segment about markets. Hello, everybody. This is Brent Foster, CEO of Northbound Wealth Management. I'm going to give a little technical analysis spotlight. What I like to do is pull up a chart. If you guys have kind of like any kind of financial resource online, I use stockcharts.com. I use Y charts. What I have pulled up in front of me is a daily chart of the S&P 500. I have multiple studies involved on my chart. So the first one is the ADX 14 day. Then the next one I have the RSI, or the Relative Strength Index. Then below that I have the full stochastics, and then below that I have the MACD, and then below that I have the actual MACD histogram. And further down on my chart analysis tools, I have the SPX, or the S&P 500 index, in a candlestick fashion. And then I have the 50-day moving average. I have the 200-day moving average, simple moving averages. And then I have volume, undefined. So I get to see what kind of volume's going on. It's all overlaid over each other. So I have like multiple studies to look at in one chart, and I can just snap it up, look at it, analyze it, annotate on it, and then move on. And I do that a lot throughout the day. I also have multiple studies that I apply to the annotations, to all the different charts, so that I can see the patterns, figure out my view. And that's from a near-term perspective. It's a daily chart, 1 year long. And then what I do is I zoom out from there, going out to say maybe a 2, a 3, a 5-year chart, and even further, because when you do zoom out, you do see the bigger picture of where the S&P 500 is going or trending to. Also, if you say not look at the S&P 500, let's say you pick Apple or Nvidia or Microsoft or Google or Alphabet, you can do those same types of studies, and it informs a particular view. And also, as best you can, try to remain unbiased when you're analyzing these individual equities or the indexes. You really have to be conscious of it so that you don't look at the charts and work on the charts through a biased perspective. So again, back to what I just described, I'm looking at and I'll just go over this simply and then we'll move on. But the market's closed on the 27th of January, 2025. S&P 500 is at 6,012.28, and that's just above the 50-day simple moving average of 5,981.52. And it looks like the market closed and kind of landed just above where that's at. We'll see what happens tomorrow on this daily chart. But the 200-day moving average is also on here, and the 200-day simple moving average is all the way down at 5,611. So we're significantly above that, and we have been for quite some time. If I look at my chart all the way back to August, on this particular chart, we were kind of trading in between the 5,100 to 5,150 levels on the S&P. So we had a bit of a correction there, and that was the last really low that we put in. After that, it's kind of been bouncing off the 50-day moving average, sometimes breaking through it, but then regaining support and moving higher. The market is definitely in a bull market uptrend from a longer term perspective. Plenty of reason to be supportive. Earlier in the podcast, I talked about earnings. And when you have earnings expectations that are in growth in earnings, you should expect the equity markets to do pretty well in that year. It doesn't mean that something strange can't happen or whatnot, but overall, it's generally good news. So for 2025, we kind of started off with a correction. We hit kind of a little bit of a bottom at around 5,800, and just slightly below that, we ripped higher to 6,100 to all-time highs once again. And then we pulled back, and now we're kind of correcting some of that big gap up that we had. And we're kind of sitting right around that confluence of support at the 50-day simple moving average. So keep that in mind. If that particular confluence area breaks, we'll probably test that 5,800 level again. But if that support level holds, then we may continue to trade sideways a bit, and until all the earnings and guidance is digested throughout the quarter of this Q1 of 2025. And a lot of the reports are based on Q4 earnings. So guidance is very important as companies are assessing their perspectives looking forward into 2025. This really does help inform the view. I like to really look at also a couple other studies. I've talked about them before on the podcast. One of my indicators is on the New York Stock Exchange and not on the S&P 500. So the NYSE McKellen Summation Index, ratio adjusted EOD index. And I like that because it has 3 different studies and it's an oscillator. Kind of helps inform a view of whether we should be buying or selling, or whether we're in a correction or a distribution, or are we in accumulation. And so it's really helpful to see that. It is a bit of a lagging indicator. It only updates once a week. So I have to check that. It's on Tuesdays, so I need to look at that tomorrow and make a determination as to where we're at. But prior to today's sell-off, looks like the NASDAQ was down 3% today, and the S&P was down 1.46 today. The Dow was up 65 basis points. So there's like a rotation back into value, away from growth, away from tech. And it's kind of a catch-up trade for the value investors out there who have been sitting in cyclicals or staples or industrials or financials. You're seeing a bit of a rotation out of the growthier names into the undervalued names that are more value-oriented. And then I would not be surprised if we get a counter rotation back into the tech space once this deep seek spook from China is kind of subsiding and off the table as far as people's knee-jerk reactions. I think it's an overreaction to have this quite of a sell-off in the NASDAQ of 3%. That's pretty substantial in one day. So I think buyers are going to assess where the NASDAQ's trading, the companies involved, the profitability, the comments from a lot of these companies, the technicals of a lot of these companies have done really well over the last couple of years. And then we get a rebound back. Buyers come back into that tech space. So I wouldn't be surprised if it doesn't just continue to bleed out like 3% a day. I would be shocked if it did, actually. There's a lot of profitability in these tech companies. So anyway, I just gave you a little bit of a perspective. Very simple. I'm trying to stay layman's. I'm trying to be provide an overview, but we're in a super cycle bull market that's going to last for many, many years, in my opinion. And whenever there's a substantial pullback or correction, it's a great time to talk to your financial advisor about adding cash to risk-based assets in areas that are going to do well. But again, talk to your financial people about what it is. If you're not a client of mine, if you're a client of mine, I'm looking at all of this stuff. If you have questions, reach out to me. But I'm excited about the equity markets. I'm really excited about the next 3 to 10 years and how things are going to be going over that period of time. So I hope you enjoyed this podcast episode, and I'm going to try to provide more and more information that's timely, relevant, educational, and not boring as best I can. All right. Thank you for listening. Stay tuned. Every week, I'm going to be releasing a podcast. Like, subscribe. Thanks so much for listening, and take care. Have a great week and weekend.